Okay, here's the info slide. Welcome everybody to today's SoFiE Seminar. I apologize for the tech issue that we had earlier. This apparently is a global issue with Zoom today, but it looks like we're going to make it work. Today, let me see what I'm supposed to say. We're very excited to have Ralph Koijen and Xavier Gabaix as our speakers. Ralph will be the main speaker and his co-author Xavier is here to answer that really hard questions, I guess. We have as Discussant Lutz, Kilian. We're going to have the same format as the last few seminars. So the speaker will have 40 minutes, the discussant will have 10, and then we'll have 10 minutes for Q&A. And after the end of the main part of this seminar, we'll turn off the recording. And then if you'd like to stick around and ask some more questions in an informal setting, you're welcome to do so. During the main part of the seminar, though, we'll try to keep the same sort of more moderated format that we've used in the past. So if you'd like to ask a question, maybe pose it in the chat box down the bottom. And then when there's a break in the presentation, I can ask specific people to unmute themselves and ask their question of Ralph. Okay, so with that, Ralph, if you'd like to share your screen, you can begin.
Wonderful. Okay, let's see whether this works. Can you see my screen?
Yes, looks great.
Okay, super. Okay, well, thanks so much for the opportunity to present our paper. So this is joint work with Xavier Gabaix, as Andrew mentioned, the basic motivation for this paper is that in a lot of circumstances in macro and asset pricing, we're interested in estimating aggregate elasticities and aggregate multiplier and causal linkages more broadly. But it's really hard to find sort of like instruments in a lot of these circumstances. And so what we do in this paper is that we introduce a systematic way of constructing such instruments. And we're going to refer to that as granular instrumental variables, or GIVs in short. And so the basic idea is the following. So we're going to build on a literature that shows that idiosyncratic shocks to like large firms, large countries, or industries have a non-trivial impact on macroeconomic aggregates. And so you can think of sort of the economy being made up out of these like incompressible grains, and that means that these like idiosyncratic shocks to these large entities survive in the aggregate. And that means that we can start using those idiosyncratic shocks, like let's say shocks to TFP or shocks to demand, as instruments. And so I'm going to give you a couple of examples on the next slide of how this works. But the basic idea behind the paper is that we're going to proceed in 2 steps. So first, we're going to start from the raw data, take out common factors to isolate sort of clean idiosyncratic shocks. And then secondly, we're going to optimally aggregate those idiosyncratic shocks to obtain the most powerful instrument. And so just to sort of like fix ideas, here's a couple of examples of like parameters that we can estimate that we would be interested in. So for instance, one example would be the spillovers across countries of sovereign instability. So imagine that all of a sudden the Greek government calls for a referendum. It's going to have an impact on the yields in Greece, but it's going to spill over to other countries in peripheral countries in Europe, like Italy and Spain and Portugal. And so we can use a shock to Greece as a way to measure the spillover of sovereign instability. Another example is that we can sort of like measure the impact of capital flows on asset prices. So we can isolate idiosyncratic shocks, demand shocks or flows, to a particular institution or set of institutions and measure the impact on equity markets, bond markets, and currency markets, for instance. Another example is related to the growing literature in macro that tries to sort of model the micro to macro multiplier and tries to quantify it. And so the idea here is, for instance, you can have an event such as like Brexit or a slowdown in the US or in China. You're interested in how that spills over to aggregate global GDP. Okay, and so in all of those cases, estimating these aggregate like multipliers and elasticity is a hard task. And in some cases, you could be lucky that you have a good instrument such as tax reform or the China shock. But that typically only works for like some countries or during certain episodes. And so GIVs is going to provide a more generic approach to finding instruments using those idiosyncratic shocks. Now, what is important to emphasize and to clarify from the beginning is that GIVs are designed to estimate aggregate macro effects. And so it's complementary, but very different from Bartik style instruments that are designed to estimate cross-sectional or micro effects. So for instance, if California receives $1 more than Illinois, then the GDP of California is going to go up by X dollars more than the GDP of Illinois. But we can't say anything about sort of what happens to aggregate GDP in the US. So our paper is obviously related to lots of different papers, but the two literatures that we're closest to are the ones where people are looking for instruments in macro and asset pricing on the one hand, and the other literature is where on the literature on granularity, where we try to sort of trace back like fluctuations in aggregate time series back to micro shocks at the firm level or industry level, and so both of these literatures are developing sort of like rapidly, and we're sort of in the middle between those literatures. Now let me give you the outline for today's talk. So we're going to start like with a really simple example, just to develop the intuition. And we're going to really go back to the simplest like supply and demand example. And once the intuition is clear as to how we can identify some of the key parameters that we're interested in, we're going to sort of like ask questions like, how far can we push this? So we're going to generalize the procedure to allow for like multiple factors with arbitrary like exposures to those factors. We're going to allow for heteroscedasticity and all kinds of extensions, and see how far we can push it. Okay, we're going to be clear about like what we can and what we cannot handle, and potential issues with robustness or misspecification. And then there's a variety of empirical applications that we explore. So in the GIV paper, we have two applications. One is sovereign yield contagion during the European sovereign debt crisis, the example that I just mentioned. And the second example is estimating demand and supply elasticities in the global oil market. The other application that is not part of this paper, but is actually a paper that we're about to release, is trying to understand like why the stock market is so volatile. And I'm going to show you some results of that paper, because we actually wrote the GIV paper in order to estimate one of the key parameters in that model, which is the elasticity of the aggregate stock market. Okay, and so I'm going to show you like sort of like a high-level overview of what that model implies and what the estimates tell us. So that's sort of the outline for today. So this slide is very important. So it's giving you the relevant notations that we're going to use. So SI are the relative size shares. They sum to 1. So granularity is going to refer to the fact that there's going to be some entities, some countries, or some firms that have a relatively large SI, relatively large size share. We're going to form two averages. So the first average, indexed by E, XE, is an equal weighted average. And the second average is a size weighted average, XS. The difference between the two is what we're going to refer to as X gamma. So whenever you see a subscript gamma, it's the difference between the size weighted and the equal weighted average. Now, whenever there's heteroscedasticity, so think of XI as being growth rates or demand shocks, and obviously we're going to encounter heteroscedasticity empirically, then it's optimal to not use like 1/n in averaging these different growth rates. But the optimal thing to do is to use inverse variance weights. So whenever you see like E tilde or X gamma tilde over here, that refers to inverse variance weights instead of 1/n. Okay, so that is sort of the basic notation that we're going to use. Now to develop the main intuition and the main idea, we're going to start from a very simple example. We're going to refer to this as a simple model of the oil market. So think of like country I's demand for oil. And let's denote that one by DIT. It consumes a portion of the aggregate quantity, Y bar, think of that as the unconditional quantity. It's going to consume on average a fraction SI of global demand. And then there's going to be demand shocks, YIT. Now the structure of those demand shocks is going to be as follows. So there's going to be a common factor eta T. So think of that as that there could be like broad economic activity that's going to impact like all countries, and different countries can be differentially exposed to that. So I don't know, think of like what's happening sort of like in today's economy. There's going to be a global shock, and different countries are going to be differentially exposed to that. Okay, so that is lambda I eta T. But then there's also idiosyncratic shock. So there could be an idiosyncratic sort of like shock to certain countries that sort of like where their economy slows, and that's the UIT. So we can compute aggregate demand as summing it across all the countries is equal to Y bar, and then you get 1 plus, here you have like YSD. So it's the sum of the size-weighted demand shock across all the countries. So that's the demand side. So then for the supply side, we're going to assume that supply is elastic. So we're going to have the same Y bar over here, and it's going to respond to prices. So PT over here is the deviation of the price from its long run value. Alpha over here is the inverse supply elasticity. So it tells us how much supply responds to price movements. And then epsilon T is the supply shock. So we can solve for equilibrium prices by setting demand equal to supply. And we're going to get that the price is equal to alpha times the aggregate demand shock plus epsilon, which is the aggregate supply shock. Okay, but of course, aggregate supply and aggregate demand shocks, the epsilon and the eta, those may be correlated with one another. And so we can simply estimate alpha through OLS because it would be biased. And so the key identifying assumption that we're going to make, and that's really behind our approach, is that there are these idiosyncratic shocks over here, the UITs. And those idiosyncratic shocks are assumed to be uncorrelated with eta and with epsilon. Okay, and that's going to be that's going to allow us to identify the parameter alpha in this case that we're after. So let's see how that works. So we're going to simplify it even further and assume for now that all the countries have the same loading on that aggregate demand shock. So everyone has a loading of 1 on eta, and then you're going to have the idiosyncratic demand shock UIT. And then we're going to form our two averages. So you're going to have like YST, it's the size-weighted average of demand across all countries. And we have YET, which is the equal weighted average. Now, if you write that out, then the size-weighted one is eta plus UST. The equal weighted average is eta plus UET. So you see that the eta shows up in both equations. And so our first sort of like example of a GIV is where we simply compute ZT, the instrument, as being Y gamma T. Remember that Y gamma is the difference between like YS and YE. Given the fact that you have eta showing up in both terms, it's going to cancel out, and we end up with U gamma T. So you get the difference between the size-weighted average of idiosyncratic shocks, where you're going to put more weight on the large firms or the large countries, minus the equal weighted average across all countries. Okay, and so this is going to be our instrument. So let's see how this works to identify alpha, the supply elasticity. So the three equations on top are the ones that you have seen already. It's just a summary of what we have so far. So the first equation, YST, is the aggregate demand shock. Then you have the equilibrium price equation that reflects demand shocks and supply shocks. And then you have the instrument over here as ZT, which is just an aggregation of idiosyncratic shocks. Now that instrument has sort of two important properties. One is it's exogenous, so it's uncorrelated with aggregate supply shocks because it's just an aggregation of idiosyncratic shocks. But it's also relevant because it shows up in terms of the total demand shock depends on UST, and ZT depends on it as well, and that's why the two are correlated with one another. And as a result, it's a relevant instrument. And so now we can form the moment condition that price minus alpha YST times ZT, the expectation of that one is equal to 0. And so in this way, we have identified our parameter alpha, the inverse supply elasticity that we were after. Okay, now of course we did this in a setting with like lots of very strong assumptions, but it gives you the main idea that we're developing in this paper. Now, you may wonder, given that all that we need are seemingly idiosyncratic shocks, which are generally present in all of our models, and obviously like it's easy to come up with examples, you may wonder in what circumstances does this work, or does it lead to like a sufficiently strong instrument? And so in order to get intuition for that, it's useful to work out in this very simple example what the asymptotic variance is of the estimator for alpha. So sigma alpha is the asymptotic variance of the estimator. And here you see the expression, and it depends on two sort of like relevant terms. The first one is the ratio of sigma epsilon to sigma u. So that is the volatility of supply shocks relative to the volatility of idiosyncratic demand shocks. So what it tells you is that you're going to estimate alpha more precisely when idiosyncratic shocks are more volatile. So a good situation to apply GIV is where there's like very volatile idiosyncratic demand shocks relative to the aggregate shocks. The second component over here is this little h. And little h, you see the expression over here, That is the excess Herfindahl index. So it is minus 1 over n plus the sum of the size share squared. So just to give you some intuition, suppose that all of the countries would be of equal size, then H would be 0. So if there's very little concentration, then you'll see that H is going to be relatively low, and that means that we have very little precision in our estimate. However, if markets are very concentrated, or there's some very large countries, then we're going to gain in terms of precision, and sigma alpha will be smaller. Okay, and so just to give you some idea, like GIV is likely to work well in scenarios in which there's a couple of like large firms, large industries, large countries, and when there's like large idiosyncratic shocks. So in those circumstances, GIV is potentially useful to generate instruments. Now, luckily, the whole literature on granularity that I referred to in the beginning, that literature is making the point that these idiosyncratic shocks really make up a very non-trivial fraction of aggregate fluctuations. And so these conditions are likely to be satisfied in a wide range of situations that otherwise we wouldn't have instruments for. Okay, so far we've looked at a very simple example, and we made lots of like really strong assumptions to just kind of develop the idea. And so what we're going to do next, and I'm going to give you a couple of examples in the slides and a lot more there's in the paper, of like how far we can push this in terms of generalizing this logic. So first, like we assume that the sizes are constant over time. You can allow them to be time varying, and the relevant moment condition changes to that SIT minus 1 times UIT times the aggregate shocks. That expectation has to be equal to 0 now. I'm going to show you on the next couple of slides like what happens if the idiosyncratic shocks are heteroscedastic, what the optimal ways to combine these idiosyncratic shocks, because in principle every idiosyncratic shock is a valid instrument. So why wouldn't we construct many different instruments? And we're going to show you that like what the optimal ways to aggregate. Then we're going to sort of like think of other empirically relevant scenarios where, for instance, there's a richer factor structure. If demand is also elastic, what if the demand elasticities are heterogeneous across countries or across firms or investors? And we're going to think about sort of more conceptually what makes for valid idiosyncratic shocks, given that they play such a central role in what we're doing. I'm going to talk a little bit about misspecification and cases in which you would be concerned and what kind of misspecifications are fine. Okay, and then again, like the paper is going to sort of like discuss more general setups. Okay, so let's first consider the case in which there is heteroscedasticity. So in that case, what you're going to do is that everything that I just told you is going to go through, but all you have to do is to replace 1 over n to construct the equal weights with the E tildes. So you're going to use inverse variance weighting, and then other than that, everything else is going to go through. So you're going to construct gamma tildes, which is S minus E tilde. You're going to construct the Z in just the same way. And this gamma tilde still has a property that if you sum it up across all countries, it's going to sum to 0. And it has another desirable property that we're going to need in a little bit, which is that the expectation of U gamma tilde and U E tilde is equal to 0. Okay, and so that moment condition is something that is implied by this weight vector that is going to be relevant for us. The second question is why wouldn't you construct other linear combinations of these idiosyncratic shocks? And in principle, you may want to do that for over-identifying restrictions tests, as we'll talk about later. But if you only care about sort of like getting the most accurate estimate, then the weights that we have given you are the optimal ones. And so in what way are they optimal? Suppose that I'm going to form a linear combination of these demand shocks, gamma, with the property that the weights sum to 0. So the weight summing to 0 makes sure that the aggregate shock is going to cancel out. And so suppose we now want to solve the problem where we want to have the most accurate estimate of alpha, subject to that constraint that the weights sum to 0. Then we show in the paper that the optimal weighting vector is the one that we gave you. Similarly, alternative ways of showing this is optimal is if you think about the GMM estimator with all the different moment conditions you can form with all the possible U's, then if you form the optimal weighting matrix, you're going to get the same weights again. Also, if you assume normality, then this is also the maximum likelihood estimated. Okay, and so adding other linear combinations of the U's will generally not help. All the information is already contained in what we constructed. Now, what about adding a richer factor structure? So that one is empirically important. So you're going to, of course, like so far we assume that there's like one factor and that every country has the same loading on that factor. Now, suppose that in reality, demand shocks have a much more complicated structure. There's going to be regional factors, perhaps, and various aggregate factors. So suppose there's like R factors, and different countries have different loadings on those factors. Okay, so there's going to be lambda i's. Then what we show in the paper is that what you would do is you would first run like a factor analysis or principal components to extract these common factors. You estimate the residuals, and let's call the residuals that we estimate UITE. Okay, and then effectively from there onwards, you can just continue as before, where we use the estimated idiosyncratic shocks UITE to form our instrument ZT that you see here at the bottom. Okay, so everything proceeds as before. Now again, when does this work? So here we have like more formal assumptions that you need for this to work. The first one is critical. The second one can be relaxed. So the critical one, which is really the identification condition for GIV, is that the vector VU, where VU is the covariance matrix of the idiosyncratic shocks, like VUS should not be spanned by the factor loadings lambda f. So let me give you like two examples where this would go wrong. So one example would be where suppose that the idiosyncratic variance of a given country is inversely related to size. In that case, you would violate this condition and you wouldn't be able to use GIV. Now, luckily, even though it is the case that smaller like firms or smaller countries tend to have more volatile idiosyncratic shocks, it's typically not as as aggressive as inversely related to size. Another example where this would go potentially wrong is if the loadings on the factor are directly related to size. In that case, if you have homoscedasticity, again, you would you would violate assumption one. Okay, empirically, you'll find generally that there's again a link with size, but it's not as strong as directly proportional to size. Now, the second assumption is that that we're going to make is that VU is diagonal. So there's like truly idiosyncratic shocks. That's an assumption we can actually weaken a lot. And so we discuss how it could be like if it's, let's say, block diagonal, or there's some like limited correlation across shocks. GIV will still work. Okay, but for simplicity, we're going to assume that VU is diagonal for now. Okay, so the next extension that we're going to consider is where we're going to assume that demand is also going to respond to prices. So to recall, what we've done so far is supply was elastic, we estimated our alpha, and demand was inelastic, and it was just like a combination of shocks. So now we're going to have a model for demand. That's the first equation over here, where demand responds to prices with coefficient phi d. That's a demand elasticity. Supply equation is the same as before. Now, what we're going to show you, just to preview the result, is that if you have disaggregated data on just one side of the market, then you will be able to estimate both the demand and the supply elasticity, both phi d and phi s. Now, if you were to have disaggregated data both on the supply and the demand side, then of course, I know that's all the better. You can use it in two ways. One is to construct an over-identifying restrictions test, or to get a more accurate estimate of these key parameters. But in terms of like the data requirement, all we need is disaggregated data on one side of the market, and we're good to go. So we take these supply and demand equations, and we solve for the equilibrium. And it is useful to stare for a second at what you get for the equilibrium quantity, YS, and the equilibrium price that we observe in the market. So if we first look at the equilibrium quantity, then it is equal to some multiplier M that is given over here. It's a combination of supply and demand elasticities. And then it's multiplied by 3 shocks. The first one is US, which is a size-weighted average of idiosyncratic shocks, the aggregate demand shock eta, the aggregate supply shock epsilon. And so suppose someone would just give us idiosyncratic shocks, and of course we're going to have to estimate them later, but suppose someone were to give us idiosyncratic shocks UIT, then you would simply run an OLS regression of the aggregate quantity on US, and you would be able to estimate M. Similarly, if you look at the expression for equilibrium prices, it is M over phi S times the same sort of like 3 shocks with different coefficients over here. And again, so if someone were to give us US, we would run a regression of prices on US, and we would able to estimate M over phi S. As M just depends on phi S and phi D, you can back out both elasticities. Okay, and so we're gonna sort of like operationalize that when we don't get the UIs for free, but we actually have to estimate or uncover them. So the first line over here just like recalls the demand and supply equations we had on the previous slide. So we're now going to form the same size and equal weighted averages that we've seen before. So it's kind of the same trick over and over again. If we form the size weighted average, it's phi D price plus eta plus USD. The equal weighted average is phi dP eta UET. And so you see that the first 2 terms are identical again. And so that means that if we form our instrument Z, which differences the size weighted and the equal weighted averages, then we directly get our U gamma again, which is the one that we want and the one that we need to estimate the parameters. And so it's still exogenous with respect to epsilon, eta, and importantly also UE, like we had before. But it is also relevant. Prices, they depend on aggregate demand shocks, and aggregate demand shocks are made up out of these common factors, eta, and the size weighted average of idiosyncratic shocks. And so as a result, the instrument is also relevant. Okay, so what do we do with this? If we go back to the solutions for the aggregate quantity and the aggregate price, then this was our quantity equation, YSD, M, and we had our USD. Now we don't exactly get USD, we get U gamma, so we get the equally weighted average of these idiosyncratic shocks, but we're going to fold those in the error term over here in EY. And given the fact that we have that Z is still uncorrelated with UE, it does not introduce a correlation between Z and E over here. And so that means that in this way, we can simply run an OLS regression and use standard OLS inference to estimate our multiplier M over here. And in a lot of cases, that's the parameter we care about. If you think about the micro to macro multiplier or the impact of capital flows on prices, these are like multiplier estimates. And that's really what we directly want to estimate, and it's just an OLS estimator. For prices, the same logic applies. In that case, we estimate M over phi S. Okay? Also just OLS. Now it's very tempting, once you have M and you have M over phi S, to just back out phi S and phi D and just use those estimates and think that those are OLS estimates too. But here you got to be careful, because if you back out those parameters, then they are actually IV estimates. And so what we show is that the IV estimator that this corresponds to is where you're going to instrument for prices using our little z. So this is the first stage. You take the projected value and you use that one to estimate the supply elasticity by using the aggregate quantity, S or YS. And you can use the equal weighted average to estimate the demand elasticity. And here, all the standard inference of IV is relevant. So you got to be worried about, let's say, weak instruments and things like that. And again, like we showed before, the instrument could be weak whenever there's not enough granularity, when there isn't enough concentration, or when the idiosyncratic shocks are not sufficiently volatile. Okay, and so that's sort of like an indication as to when GIV may or may not work. Okay, so as a last sort of extension that I want to briefly mention, because we're going to use it empirically, is what happens if you have heterogeneous demand elasticities. So now we're having phi ID over here instead of a common elasticity that we had in the previous slide. We're going to consider the case where the heterogeneity is parametric. So what it means is that phi ID, we're going to model it as a linear function of characteristics of that particular, let's say, country or firm. So if you think about a firm, you can imagine that that characteristic could be like log size, the leverage of the firm, whether it's profitable. All of those things can lead to different like elasticities. And how these characteristics are aggregated is controlled by this parameter phi.d, and that's the one we want to estimate. So plug that one into the demand equation over here. And what you get is that our demand, the vector of demands, is going to depend on those characteristics times this coefficient matrix and price, aggregate demand exposure, idiosyncratic shocks. Now, how do we proceed? We're going to form two matrices, Q and R. The expressions for Q and R are given here at the bottom. What's relevant for us for now is that Qx is equal to 0 and Rx is equal to the identity matrix. Now, as Qx is equal to 0, if you multiply this whole equation through with Q, then the first two terms are going to be equal to 0 because Qx is 0. And so Qy is equal to Qu. And our little z over here is going to be the size-weighted average of those Qy's, and that's the size-weighted average of Qu. And so, Qu. And so as a result, we directly get a linear combination, again, of idiosyncratic shocks, even though we have heterogeneous elasticities, heterogeneous loadings on those factors. Okay, and then we can form these moment conditions to estimate the coefficients phi.d and the supply elasticity phi s. Okay, and in the paper we push it even further and show how you can also allow for non-parametric heterogeneity in these elasticities. Okay, so given that we talked a lot about idiosyncratic shocks, you may wonder at this point, like, well, what makes for an idiosyncratic shock? Like, and sort of intuitively, it's anything that's uncorrelated, like a UIT that's uncorrelated with eta t. Okay, so if you think about like firms, you can imagine like Apple introduces like an iPhone. If you think about the oil example, there's like the Gulf War, Iraq and Kuwait's like supply drops to essentially 0. Those are all counted as valid idiosyncratic shocks. But there's actually like more applications of this beyond that. So in a simple example, we had this constant loading over here. But there's interesting work that shows that there's like uncertainty in those loadings and there's shocks in these, I don't know, betas or lambdas, exposures to these common factors. And so suppose we now consider a slightly more general model where there's like an average loading lambda I, and then there's variation around it lambda check. And suppose that lambda check is uncorrelated with eta, and it's also uncorrelated with eta squared. Then in that case, this form of U, which actually includes an aggregate shock over here, eta, but it's multiplied with an idiosyncratic exposure, is also valid as an idiosyncratic shock. And so one example would be that if you have, let's say, the Fed or the ECB runs a stress test for banks, and you learn that the exposure of certain banks to an economic downturn is different than what you thought, then those would count as idiosyncratic shocks you can use for identification. Now, on top of that, once you identify or you isolate your idiosyncratic shocks, in some cases, if you have the data, you can narratively check what actually happened and convince yourself and others that these are truly idiosyncratic shocks. Before going to the data, let me sort of like spend a little bit of time on talking about the robustness to misspecification. So there's three sort of dimensions in which we think misspecification could be important. One is where there's only a subset of the shocks you can use because, for instance, you have good data for only the large firms or a subset of them. In that case, everything goes through. The Z is still a valid instrument under the assumption that the idiosyncratic shocks of the entities you leave out are truly idiosyncratic shocks. So they're not correlated with the ones you include. A second form of misspecification is that you accidentally assume that elasticities are the same across entities, but in reality, they're heterogeneous. In that case, if you control for the common factors properly, then it would still work. The parameter you're estimating is phi e. But if you don't control properly for the etas, then the estimate would be biased. If you misspecify size, that really doesn't matter much because in that case, it still is a valid IV. It's just that it's just less efficient. So using size is the optimal way of aggregating. Using the wrong size vector or a noisy size vector is just an imperfect instrument, but it's still valid. The OLS estimate in that case, though, can be biased. Okay, so with that in mind, sort of like to sum up, we think that the GIV approach, by using some of these idiosyncratic shocks, can be sort of like used in a variety of settings to estimate some of these aggregate parameters. We consider generalizations in the paper, but let me now sort of like turn to the data to show you some examples. So one example that we illustrate in the GIV paper is the supply and demand in oil markets. And so here we're building on seminal work by our discussant Lutz, Kilian, where we're trying to estimate the supply elasticity phi s over here, where delta YIT is the production of a given country. We're going to model it as a response to prices, exposure to common factors, idiosyncratic shocks, and then there's a set of controls. There's also oil demand. There we use just aggregate data. They respond to price. That responds to prices as well. Demand elasticity phi v, presumably negative. Same controls and some aggregate demand shock. So we can solve for the equilibrium in the same way as we did before, and apply a simple version of GIV. So what you see in the table over here, the first two columns this is a multiplier m over here. This is m over phi d. It may be most instructive to look at the elasticity estimates, which you find here at the bottom. So the minus 0.38, that's the demand elasticity. The 0.05, that is the supply elasticity that we estimate. Now, if you compare that to some of the estimates in the literature, then in Killian and Murphy, they impose bounds on the short-run supply elasticity of 2.5%, 5%, and 10%, and the corresponding demand elasticities range from 44 to 47%. If you look at Baumeister Hamilton, you see similar estimates, and in Caldera and co-authors, again, you see quite similar estimates. And so in this case, using a fairly sort of like simple approach, at least ballpark, we're sort of in the same region, it seems. Now, then I want to sort of like spend the last part of this talk to talk about the application that we actually wrote, as I mentioned, for which we wrote the GIV paper. And so the question here is like, why are like financial markets so volatile, which obviously is kind of getting a lot of attention also nowadays. And modern asset pricing theories, of course, provide you an answer. They tell you that this is related to like time varying risk aversion, macroeconomic risk, changing beliefs. But of course, the challenge that we've had in asset pricing or macro finance is that it's been very hard to really directly measure those variables, leading to sort of like dark matter and asset pricing models. Now, there's one common feature across these models, both rational and behavioral, and that is that markets are macro elastic, meaning that if you move $1 from your bond fund to the stock market, then prices will move very little. So if you buy 1% of the market in these models, prices move by less than like 0.1%. So elasticities are like well over 10. Now that is like a little puzzling at first sight, because like in the same models, if you compute the micro elasticity, so not moving money from bonds to stocks, but exchanging Google for Apple, then the micro elasticity in these models is typically much higher. But we have good estimates for the micro elasticity, and it's typically around 1. And so if we think that the macro elasticity should be below, then it should be somewhere below, plausibly below 1. And so we're going to sort of propose an alternative complementary view, and that's that markets are macro inelastic. So the idea here is that small shocks to capital flows are going to have a large outsized impact on prices. And so we're going to refer to this as the inelastic markets hypothesis, the idea that flows affect market prices in a quantitatively meaningful way. Now, how are we going to sort of like get there? Like, why are markets so inelastic? So here's a quick inspection. If you look at what some of the large institutions are doing. So look at mutual funds, look at ETFs, look at pension plans, and all of those, if you look over time, they're like allocation to equities, the fraction they invest in equities is like virtually constant. So for pension funds, it's somewhere around 70%, it's like 90% for mutual funds, and essentially 1 for ETFs. So there's not a whole lot of timing the market going on, or there's like very little trade between institutions. And so let's sort of like explore the implications of such behavior for asset prices. So we're going to consider like a really simple model, and the paper is going to contain a much more general model with 2 assets. There's a stock with like fixed supply QS and a price P. There's one bond with a fixed price and so infinitely elastic supply, supply BS. And there's going to be 2 funds. One fund is a pure bond fund. Okay, think of your money market mutual fund. And there's going to be a balanced fund. And the balanced fund is going to have a demand function that we're going to postulate right away. There's, I know, many ways to microfound this, but what you see over here, the left-hand side, is a fraction that the fund is going to allocate to equities. There's some long-run average theta, let's say 70-30 equities bonds. And it's going to show some responsiveness to risk premium. So pi hat is like the deviation of the risk premium from the long-run average. And kappa sort of controls how responsive you are. And so the basic point is that in all of our standard models, pretty much, kappa tends to be very, very high. If there's a small change in risk premium, you should see very large shifts in their asset allocation, which we don't seem to see in the data. Now, of course, whenever funds have such a mandate, then and consumers are rational, it wouldn't matter because they would just reallocate in terms of flows. But obviously, it's very hard to know exactly what your pension fund does, what your insurance company does, or even what you're currently doing in your 401k plan. So with all that in mind, sort of like we think that there's some form of bounded rationality that some of these institutional constraints may not be undone. Okay, so let's sort of see what happens in this economy. So suppose that before time zero we're in equilibrium, so pi hat is zero, no deviation of the risk premium, and let's call delta the average dividend yield, so something like 3-4%. Then suppose at time zero, I'm going to decide to take some of my money out of the bond fund and move it into my mixed fund. And I'm going to move delta F dollars. So as a fraction of the value of my mixed fund, that's a little f. So that's the percent flow. Then what we show in the paper is that the price response, the return that you see in the stock market upon me moving money from bonds to my mixed fund is F over zeta. And zeta is sort of this key parameter that we care about. It's the macro elasticity of demand. 1 over zeta is the multiplier, it's the macro multiplier. Now, what does zeta look like? Zeta is 1 minus theta, okay? And again, think of theta as like something like 80-90%. And then plus kappa, think of kappa somewhere between 1 and 2, times delta 3-4%. So that means that if you calibrate this to reasonable numbers in the data, you'll find that zeta is something like 0.2, which is sort of nicely below the micro elasticity of demand that I mentioned, as I know you would plausibly imagine it is. But it does mean that flows have an enormous impact on the stock market. So if you have a 1% inflow into the stock market, it's going to move the market by 5%. So if you buy $1, then it's going to move prices by $5. Okay, and that's in sharp contrast to standard models. So how we're going to estimate this in the data? So calibration sort of suggests that the market could be very inelastic. Now we're going to directly estimate it. And we're going to estimate it using 2 data sources. One is flow of funds and one is 13F data. So we're going to have a similar demand equation as before. So you're going to have the percent change in equities for investor J. It's going to respond to prices, macroeconomic growth over here, some common factors, and then you have idiosyncratic demand shocks. So it could be a demand shock that like pension funds have, foreign investors, mutual funds, you name it. So you can work out prices, and again, suppose someone would give us the idiosyncratic shocks to either investors or firms, then we could directly estimate our multiplier M, which is again 1 over the elasticity. And so if we use flow of funds data, then what you see in this table in the first 2 columns are estimates of this multiplier. The first column is with 1 principal component, the second column with 2 principal components. And so if we focus on that second column, what it tells you is that if you buy 1% of the market, then it's going to be amplified by a factor of 5 and prices will go up by 5%. If you translate that to elasticities, which are these over here, you'll find an elasticity of something like 0.2. The corporate sector, which is over here, has a very low short-run supply elasticity. So firms could act as arbitrageurs over longer cycles, but within a quarter, which is the frequency here, the elasticity is very, very low. Over longer horizons, we don't find any evidence that these flows tend to mean revert. Now, of course, if you go to longer horizons, then the standard errors blow up as well. So there's, I don't know, not that much we can say. But at least there's no evidence that these flows, these price effects mean revert. And that's actually consistent with our model. So in our model, if there's a permanent inflow into the stock market, prices will be permanently higher and expected returns will be permanently lower. Okay, and so that means that the empirical strategy we see a lot where we look for reversals in prices upon flows. It's true for flows that are mean reverting, but that is not necessarily true for flows that are permanent. Okay, so then we cross-check this using another data set, which is 13F data. An advantage of the 13F data is that we have a very large number of institutions. So this is every institution, foreign and in the sort of domicile in the US, that manages more than $100 million. And so you have a very large number of funds, which is great for our approach. And so here we also use parametric factors because we have lots of information about those funds. We know how large they are, and we know how active they are. We know like features of their portfolio. We know what is their typical beta, what is their size orientation to like small caps, large caps. Are they tilted towards value or growth firms? Okay, so we have lots of information about those funds, and we use that to extract all those factors, those ADAs. And then we add like a whole series of principal components. And the first line essentially gives you the multiplier. And you see that these multipliers again are something like they move between 4.6 and 7.2, depending on the number of factors. The other thing we can do here is we can construct an over-identifying restrictions test. So we can rank all the funds based on their size, and we can construct one instrument based on fund like 1, 3, and 5, and so on, and the other instrument based on institution 2, 4, and 6, and so on. And what you see in the final column is the difference over here is the difference between those two instruments. Of course, the standard errors are large, so there's not that much we can say, but at least there's no strong rejection that you find very different estimates using those two instruments. So to wrap up, like there's two important takeaways. So if we look at the final application that I just showed you, it gives us a framework to do like micro to macro in a macro finance context. And so we're bringing in quantities like portfolio holdings and flows into asset pricing and macro finance instead of just price data. What our sort of like working hypothesis is that markets are inelastic, and we provide evidence based on calibration and estimation that may be true. And that sort of contradicts like a large class of models. Now, what is the upside of all this is that two things. One is that macro finance becomes way more tangible. We can trace back variation in prices to like the flows and demand shocks of different investors. And we can try to understand why like the flow happened in the given quarter and get micro foundations for those flows and understand their behavior and so on. Secondly, it's like questions that used to be kind of like uninteresting or irrelevant in standard models suddenly become interesting. Like QE for stocks, suddenly government interventions could be very powerful, perhaps even more powerful than what you see for bonds. Or it could be the case that firms can act as powerful arbitrageurs by leaning against some of these flows and demand shocks. So most of that is really for future work, but we do discuss it in our companion paper. So the summary for GIV, we think it's a simple idea that hopefully has many applications. It allows us to estimate aggregate elasticities and multipliers. And we hope it's a fairly sort of like automatic way to construct, or at least have a path to constructing instruments, where otherwise we wouldn't have a way of identifying some of these key parameters, and we can make some progress. And so in the paper, we use this to study sovereign spillovers in debt markets in Europe, and we look at demand and supply in oil markets. And so that concludes the presentation. We'll look forward to the comments and questions from the audience.
All right, thanks very much, Ralph. And I purposely let this run a little late, given that we had the technical glitch at the start. And let me also apologize now to the people who joined partway through the talk. I know there's been some difficulty with Zoom today. So welcome to those who just joined. Our discussant today is Lutz Killian from the Federal Reserve in Dallas. So Lutz, please take it away.
Yes, thank you. So I really enjoyed reading this paper. As you may have noticed, there is a lot in there. So I'm going to limit my discussion to the oil market application in this paper. I'm going to try to give you some perspective of how the approach in this paper fits into the literature. I'm going to start with a bit of a digression, and you'll see why that is important later. This oil supply elasticity and oil demand elasticity literature really started with the proposal of an oil supply elasticity bound in an earlier paper in 2012. That paper pointed to a natural experiment in August of 1990 when Iraq invaded Kuwait, which of course was a big surprise to everybody, so a clear geopolitical exogenous shock. What did that shock do? It shifted out the demand for crude oil because storage demand increased. It also caused a supply disruption in Iraq and Kuwait, and that meant that the demand for oil produced in other countries increased. So you get another shift in the demand curve. So if you take the percent change in the real price of oil from July to August and the corresponding percent change in oil production outside of Iraq and Kuwait, and you take that ratio, you get something that looks like an elasticity at first sight, except for the fact that Saudi Arabia has a long-standing policy of directly offsetting geopolitical oil supply disruptions in other OPEC countries. And that meant that Saudi Arabia responded to this event by shifting its supply curve to the right. And that made delta Q bigger and delta P smaller. So when you look at the observed ratio, that has to be interpreted as an upper bound on the oil supply elasticity. Now, more recently, Caldara et al. In a JME paper took issue with this bound, and they pointed to the United Arab Emirates, whose oil production in August actually declined. They suggest that it declined because of a speech by Saddam Hussein on July 17, 1990, where he threatened unspecified consequences for countries that produce too much oil. Now, if their argument is correct, that would raise this supply elasticity bound to 0.045. I would argue that this is not the way to think about that, not only because there are simpler explanations, namely that the UAE had violated its OPEC production quota, and there was a lot of pressure from other OPEC members to correct that. But when you look at the data, you find that the UAE agreed to lower its production on July 11. And that's before the speech by Saddam Hussein. And so it's a very hard sell to argue that it was caused by a speech that hadn't happened yet. More generally, there was no immediate military threat to the UAE. If you look at the map, the UAE is close to Oman at the other end of the peninsula. It has no direct border with Iraq. There was no reason for them to respond. And so why is that important? Well, it tells us we need to be careful about how we treat the UAE. So I'll come back to that. Now, how would we estimate the oil demand and supply elasticities using instrumental variables before today's paper? Well, we would go back to the approach proposed by Caldara et al. In their paper. They try to generalize some of the insights from the construction of oil supply elasticity bounds. And they came up with an instrument which involved the percent decline in oil production that takes place abroad from the point of view of a given oil producer. And they interacted this decline with a narrative dummy, which says that according to their reading of the narrative evidence, this particular percent decline in oil production is exogenous. Now, once you have that instrument, you can project the change in the price of oil in the first equation here on the instrument to get a fitted value for the oil price change. And you can then relate the change in oil production in selected oil producing countries on this predicted change to get an estimate of the supply elasticity, where the trick is very similar to the argument in constructing the supply elasticity bound, namely that if oil production somewhere else goes down, well, that shifts the demand for oil from a given oil producer, right? And that allows you to trace out the supply elasticity. They applied a similar approach to estimate the price elasticity of oil demand. Again, they construct an instrument along the same principle. They get a predicted value for the oil price, and then they project the percent change in the consumption of petroleum on this predicted change in the oil price to back out the oil demand elasticity. And in this case, of course, clearly we're talking about shifting the supply, so this must be the demand elasticity. Now, here are some issues with this IB estimator. The first one has to do with the treatment of the UAE. If you do not include the UAE in 1990 in the construction of the instrument, their estimates of the supply elasticity drop to about 0.03, very similar to the bound. If you work with a broader instrument, which includes in addition smaller oil supply disruptions, after excluding the UAE, you also get a drop in the estimates that are reported in that paper. But there is an additional caveat. That instrument is weak. In fact, all the extra oil supply disruptions they use in their extended instrument relative to Kilian and Murphy are weak based on first stage F test statistics. So you have to take that with a big grain of salt, and you may want to focus on the results for the narrow instrument. So this is problem number one. Problem number two is they do not deal with the bounds problem I discussed earlier, with the fact that the supply curve of countries like Saudi Arabia shifts directly in response to OPEC supply disruptions. One way where this shows up very nicely is when you look at their regional oil supply elasticity estimates. If they look at non-OPEC countries where this problem doesn't arise, their elasticity is 0, the supply elasticity. If you look at Saudi Arabia, they come back and report a very high supply elasticity of 0.2. Now, that, of course, is not accounting for this bounce problem. How big is that bounce problem? Well, here's a way to think about that. If you focus on an episode where there was a large oil price shift that was not caused by OPEC geopolitical events, and that was exogenous to Saudi Arabia, such as the oil price change in the second half of 2014, and you take the ratio of delta Q over delta P, you get an elasticity estimate that's 0.01 for Saudi Arabia. It's much, much smaller than what you get if you don't take care of this bounce problem. So this is something that matters. Problem number 3, the global market clearing condition in Caldara et al. Equates the production of crude oil with the consumption of crude oil every period. That does not make sense because oil is storable. We all know that. The correct market clearing condition is that the quantity produced should be equal to the quantity consumed plus the change in inventories. That means in the Caldara et al. Analysis, they have an omitted variable problem. Fourth, there are no data on oil consumption growth in the world, unfortunately. And so what Caldara et al. Do is to substitute a measure of consumption growth for refined products such as gasoline or diesel. This means that what they call the oil demand elasticity is technically a cross-price elasticity of demand, not the own price elasticity that we actually want to estimate. And of course, that means the numbers may not be representative for the oil demand elasticity. So why do I bring all of this up? Well, in many ways, the approach in the current paper is conceptually similar to the approach taken in Caldara et al. The key difference is the construction of the instrument. So what the current paper does is to define idiosyncratic oil supply shocks as the deviation of country-level output growth, oil output growth, from a common factor and an OPEC factor. And then in the simplest case, you take the difference between these country-level shocks weighted by the production share of each oil producer and the corresponding equal weighted average. And the objective here is to highlight the contribution of large oil producers. Now, if we take this supply shock measure, the reason we can identify both oil demand and oil supply elasticities is that an exogenous supply shift helps identify the oil demand curve. That's standard. That's exactly what Caldara et al. Did. When we're trying to identify the oil supply elasticity, we're focusing on smaller oil producers that take as given price changes caused by supply shocks in large oil producing countries. And so from their point of view, that is a shift in the demand curve, and that's why we can trace out the oil supply elasticity. So this framework conceptually uses very similar ideas to Caldara et al. So let's quickly look at the elasticity estimates. So for the supply elasticity, they estimate 0.05. That's a little bit on the high side, in particular compared to Caldara. Once you drop the UAE, their estimate is only 0.03. For the demand elasticity, they report minus 0.38. Now, to put that into perspective, we agree based on state-of-the-art estimates that the price elasticity of gasoline demand is about minus 0.36. There is a rule of thumb proposed by Hamilton that the oil demand elasticity should be about half of the gasoline demand elasticity, and that's coming from the fact that the cost share of crude oil in producing gasoline is approximately 1/2, which implies that you would have expected to see something in the neighborhood of minus 0.18 for the oil demand elasticity here, at least if we follow Hamilton's logic. And so by that metric, this is a little bit on the high side. On the other hand, it's quite different from Caldara et al., whose estimate is much, much lower, much closer to 0. So this is a little bit different from some of the other estimates in the literature. If you extend the Killian Murphy 2014 paper and you estimate the elasticity in that paper as proposed by the original study, you're going to get minus 0.18. So let me bring up some comments and questions about the methodology here. So first, it seems that the paper inherits by default some of the issues with the analysis in Caldara et al. So first of all, there is the issue of the Saudi supply response to geopolitical OPEC supply cuts. The second issue is the market clearing condition. And the third is the measurement of oil consumption. Now, as I read the paper, there's some hints that the authors are aware of these problems, and they're discussing some things they might have done, but it's not clear enough for me to be able to tell whether they get around these problems or not, so I would be interested in seeing some clarification on this. Of course, the real interesting part of the paper has to do with the definition of the shocks. Now, we all agree that percent changes in oil production are not exogenous, right? These are just variables. So the question then is, if we take idiosyncratic deviations of countries' oil production growth from some common component, is that the same as an unanticipated exogenous shock? So the authors, for example, say, well, if Saudi Arabia does something unexpected, clearly that would be an unanticipated shock. Well, thinking about the case of Saudi Arabia, given that Saudi Arabia behaves differently from other oil producers, as an observer of the oil market, I would expect it to be different from some common factor. But that deviation, presumably, is something that is anticipated. So it's not clear to me why necessarily a deviation in this cross-sectional sense indicates that something is an unanticipated shock in the time series sense. And I would like to see how the authors think about that. That might be useful to think through more carefully. One would think that maybe a narrative approach could be used to refine what the authors are doing. I think this may be hard because Caldara et al. Restricted attention to large oil output disruptions for a reason. And the reason is that it's easier to tell stories about why such a large disruption might be exogenous. If you look at all oil production changes, that seems like a very hard thing to do. At least I have not seen anyone do that successfully. Third point, we focus on large oil producers. In the oil market, that's Saudi Arabia, the US, and Russia. Many of the historical large supply shocks came from smaller oil producers, countries like Iran, Iraq, or Venezuela, for example. So if I take, for example, a war between Iran and Iraq that gives you a nice big oil supply shock, both of these are small oil producers. How would that show up in the current framework? Are we worried about the fact that these shocks might occur in two countries at the same time, for example? So there are a number of issues here, I think, that one could discuss in more detail that might actually be enlightening. So to conclude, this is a great paper. It's very innovative. Most of the problems I just discussed are specific to the oil application. A lot of these problems have to do with the storability of oil, which makes this a really hard problem to study. So maybe it would be useful to focus more on the macro finance applications, but you don't have to do with these additional complications that have nothing to do with the innovation of the paper. More generally, I would like to see more discussion of the economic interpretation of the instrument. So I gave a couple of examples here in the oil market context. I think more generally, that would be an area where additional discussion would be helpful. Thank you.
Thanks very much, Lutz. That's great. So maybe Ralph, if you'd like to respond to Lutz, any comments you would like to?
Yeah, well, thanks a lot for
Q&A from the audience.
Sure. Yeah, thanks a lot for your thoughtful comments. So this is great to sort of learn your perspective on some of these questions in this literature. Let me say just one thing, which I think relates to your last comment, which I think is sort of like potentially a way how we can make progress in this. So if you take these large supply shocks to smaller countries, you can actually allow for like heterogeneous elasticities as I discussed in the presentation, and allow for a different elasticity from Saudi Arabia. So like supply shocks from smaller countries that like you can sort of like estimate a different response function for Saudi Arabia compared to other countries. So that I think is an interesting sort of extension to consider. For us, the oil example or application was really want to show that the estimates that we get are comparable to those in the literature, and so that's sort of like where we're coming from, just to demonstrate sort of that under similar assumptions where people have like gone through like various approaches using narrative approach, using sign restrictions, or the narrative approach, like gives us similar estimates. So that was sort of our main motivation to explore this. But I think like some of the issues that you highlighted, like or like we're aware of that, those are being discussed sort of like in the oil literature, and we'll try to sort of think about how to address those. But this is very helpful. Thank you.
All right, great. Well, now it's time for questions from the audience, and we're in a different format here, so I'm not sure exactly how best to do it. And as I'm the host, I'm not able to raise my own hand. Maybe the easiest way to do it is if people can use the raise your hand feature, then I can call on you and you can ask your question. While people are figuring that out, maybe I can ask a question of you, Ralph. When I was looking at the construction of the instruments, and in the introduction, there was a lot of discussion about the granularity, the importance of there being heterogeneity in the size of the different individual components or actors in the model. But then I wondered if you could explain where granularity actually kicks in, because it looks to me like you just need to have, and I say just in quotes, two different weighted averages across the cross-sectional units. And whether there's variation in size or importance didn't seem obvious to me that was necessary. You could construct an equal weighted and some other thing weighted, randomly weighted, as long as it's different. It seemed like that would give you the identification. Maybe I'm missing something.
Yeah, so it's right. You can form different averages and use it as an instrument. And so like in principle, you can sort of use any idiosyncratic shock as an instrument. But the important thing is that the theory sort of tells us that like we want to have like a size weighted average because that is going to give us the most accurate instrument. And so sort of like if you want to construct the most powerful instrument, then this is the best way to aggregate those shocks. And so the only reason to really deviate from that, like sort of like what we do in the macro finance application, is to kind of construct two instruments to do like an over-identifying restrictions test. But in all other cases, this is going to be the instrument. This is the optimal way to aggregate idiosyncratic shocks. That's the way to think about it.
Yeah, I see. Okay. Thank you. Now, I don't see any hands raised, and I can't identify whether that's because no one has questions or because no one's able to use the raise your hand feature. Can anyone answer that question for me? Excuse me. Maybe an alternative approach. Here we go. I see Xavier's raised his hand. So
no, it's just to make sure that it works.
We've verified that it works.
Yeah.
Yes, okay. Well, maybe what we should do at this juncture is I'll end the formal part of the recording, and then we'll switch to open mic where people can unmute themselves and ask questions. So maybe I'll do that. And at the end of each, I like to advertise next week's or the next SoFiE seminar. The next SoFiE seminar, we're going to have Gustavo Schwenkler from Santa Clara University talking about cryptocurrencies and networks. His discussant will be Daniela Bianchi from Queen Mary University of London. So please join us in a couple of weeks for that seminar. Now I will end the recording.